You kind of mentioned it. We're talking about economics and supply and demand and inflation. That's one of the questions I want to ask you, and one of the topics I had brought you here today for, and that is investing in high inflationary times. Where do you put it? Like, how do you shelter your money from it? So on and so forth. Why don't you kind of take that one?
Yeah, that's a great question. We get that frequently from clients right now. And, again, going back to history, when you look at what is the best hedge against inflation, and quite frankly, it's the stock market. I mean, the stock market has outperformed inflation. If you look at the data, inflation under 4%, the market has done pretty well over time. When it gets over 4%, like we're seeing right now, it's 7%, 8%, 9%.
Yeah, I actually pulled not to interrupt, but I pulled a stat, and it's at 8.5%, which is a 40-year high. So we haven't seen this since the 80s, which I wasn't even alive.
Yeah, that's a very high rate. And then people are impacted. I mean, you go to fill up your vehicle, and it's $60, $70, $80.
Yeah.
So I mean, just from a keeping money in cash, we're big believers in emergency funds. I mean, it is what it is. You have to keep it in the bank. The bank may be paying 0.5%, but you need to have an emergency fund. It's quote, losing money because of inflation. Mm-hmm. But from a long-term perspective, if inflation stayed above 4% long-term, the stock market does have an issue with that. 8.5% for 6 months or a year or 2 years has not impacted the stock market drastically. So if you look at the different types of places to invest, mm-hmm. international, U.S., large stocks, small stocks. Small stocks have done well historically in inflationary environments.
I did hear that.
Yeah, so if you can look at returns back in the 80s and when inflation spiked throughout history, and there's certain, we call them asset classes, that have done well. And overall, the stock market has outperformed inflation. So don't let the inflation, it's difficult on a day-to-day basis, but from an investing standpoint, if you think about it, companies are raising their prices, right, to offset the supply costs coming in, and so their profits are going up as well. So the stock market is ultimately based on the profits of companies. So their profits are going up. In some cases, if you have pricing power, their profits are going up more, right? Mm-hmm. So that means their stock price is going to go up more as well. So the stock market is one of the better places to hedge against inflation. There's another really cool, if you haven't seen this, I-bonds is also a place that you can put some money. Now, there's some caveats to that. 10,000 is the limit per mm-hmm. person, which is a good number. If you're married, it would be 20,000. The rate that was done back in November was like, I think it was 8.5%, and they're talking about it being 9%.
That's crazy.
Yeah.
That's pretty high.
It is very, very high, but there's some caveats. You got to keep it in there a year. And if you take it out before 5 years, then you lose 3 months of interest. So there's a little bit of a penalty, but so you wouldn't put your emergency fund there, right? Because you want your emergency fund liquid. But if you have, we have some people that have a lot of cash, and that would be a good place to put it. I mean, it's basically tied to inflation, and that inflation rate is done every 6 months. So you have to keep it in there at a minimum a year. But I-bonds is another place to put some money. But the stock market in general is a good hedge.
Yeah. Would you include oil as part of because I know historically oil has been, like, oil and emerging markets have been kind of the two that withstand inflation.
Yeah, you can do commodities. Commodities as a whole, oil, mm-hmm. You get into gold. The gold and silver. And that really goes to what we call as diversification. Mm-hmm. I mean, and that's a boring word, and it's people don't like diversification, but I tell you, long term, it works. It has worked very well, and because no one knows what is going to be the next hot thing to invest in, and so I like to use this example. Cancer. Most of us have been impacted by cancer, either personally or we have friends or family that have been, involved in it. So if you think about this example, if you have 10 major medical companies, there's going to be one of those 10 probably over the next 20 years, which is going to come out with a drug to cure cancer. Mm-hmm. And they've been saying that for a long time now. But if you have money to invest in those 10 companies, do you invest in all 10 of them, or do you invest in one or two of them? Well, when you start doing one or two of them, it becomes gambling.
Yeah.
Right? If you don't hit it, then you're not going to do well. So that's the diversification, theory is. And when we see long-term performance, if you can diversify and make 8 to 10%, which has been the historical norms, Dave Ramsey talks about 12%.
Yeah.
Those numbers over 10, 20, 30, 40 years, people retire very comfortably being diversified. So, just being diversified. So having, if you want to have some commodities in your portfolio, stocks, bonds are not doing real well right now. So you could use some I bonds, but just being diversified.
I kind of wanted to challenge you a little bit on this. So I've heard a lot of arguments that real estate's also a very good hedge against inflation. Now, obviously right now, I don't know if that's the case because the stock market or the housing market is also kind of white hot still. The supply is just not there. So would you agree that real estate can be a good hedge against inflation or no? Because if you going by the Dave Ramsey philosophy, you're taking on debt essentially to hide yourself from inflation.
Yeah, it can be. I mean, so, inflation is made up of a lot of different things, right? Goods and services that you're using, but also your housing. So we don't view investing in real estate. I mean, real estate can be a very good investment, but here's the difference. And real estate is an active investment, right? I mean, when you own a house or you do rentals, it's an active. You have to be involved in it. And so some people are cut out to do that. So my wife and I, over the years, I've been the one that said, hey, let's do some rentals. And my wife was like, I don't want to answer a phone call at 2:00 in the morning because the toilet's leaking. And so, and she was right. I mean, I didn't want to do that long term. I didn't know that at the time. So it's an active investment. So we've chosen to invest more in the stock market. Now in the stock market, you can do real estate. There's REITs, real estate investment, trust.
Which I actually like those because I don't know if a lot of people know, I think 10% of profits have to go back to investors.
Yeah, actually 90% goes
90%.
back.
Yeah. Sorry, I had it reversed.
It's a big number. So so there, Vanguard has a REIT and Charles Schwab has a REIT that you can invest in. So when you look back at numbers and historically real estate in those REITs versus the S&P 500, they're similar returns. I mean, so, it's just another asset class. So it doesn't give us, expanded returns. What could give you expanded return is if you invested in individual houses for rentals. We see that as another way, to generate passive income, but it's an active investment. You have to be prepared to that being a part of your life. And for some people, I have some really good friends who are killing it in that area. They do fantastic because one of my really good friends used to be a spec builder. He's also really sharp financially, and so he's built a rental business because he can have the contractors come in. He understands the language, he understands the finances, he understands the building process, and he'll buy dilapidated buildings and houses, and he'll renovate them, and he does really well. There's no way I can do that.